Did you know that during the Great Recession of 2008, the S&P 500 lost nearly 40% of its value? That is a scary thought for any investor. But here's the thing, bear markets are a fact of life. They come and go, but how you deal with them makes all the difference. In today's video, we'll show you 4 strategies for investing in a bear market that will protect your portfolio and help you make the most of the opportunities that arise. You will basically learn how to thrive when the market takes a dive. Stick around, and without further ado, let's get started. Understanding bear markets. Have you ever wondered about the reasons behind unexpected stock price declines that send investors into a frenzy? One possible explanation for this phenomenon is that stock prices are determined by investors' projections regarding a particular company's future cash flow and profits. When those projections don't come true, the stock's price might be harmed. A domino effect that develops when other people sell their investments out of fear, but also prolong the bear market. And well, a bear market is not just a normal 5% drop. A bear market exists when stock values decline by at least 20% from their prior high. However, this percentage of 20% is somewhat arbitrary and may not accurately describe a bear market's genuine characteristics. When investors are more risk-averse than risk-seeking, that is another way to describe a bear market. As investors forgo speculative investments in favor of safer choices, this type of bear market may last for months or even years. A bear market could happen for various causes, including a poor or sluggish economy, the collapse of market bubbles, pandemics, armed conflicts, geopolitical crises, or abrupt changes in the economy. Low employment rates, low incomes available for spending, low productivity, and decreasing firm profits can all be indicators of an economy that is struggling. A bear market might also result from governmental intervention, such as alterations to tax rates or the federal fund rates. Another factor is investor confidence. When they believe something terrible is likely to happen, they may sell their stock in anticipation of possible losses. So, how long can a bear market last? Well, it is dependent on the kind. Bear markets can persist for several years or only a few short weeks. A secular bear market is one that has lasted for an extended period, typically between 10 and 20 years, and it's characterized by returns that are consistently lower than average. Within secular bear markets, there may be rallies where stocks or indexes rise for a while, but the gains are short-lived and prices drop back to earlier levels. On the other hand, a cyclical bear market may persist for a few weeks up to several months. Looking back over history, we can see examples of both sorts of bear markets. The S&P 500 lost 50% of its value during the financial crisis of 2007 to 2009, a protracted bear market lasting approximately 17 months. The DJIA fell 38% in less than a month when the COVID-19 epidemic suddenly plunged global stocks into a bear market. But the good news is that markets can recover. Both the S&P 500 and Nasdaq 100 even hit new highs by August 2020. And well, it's not just the 2008 bear market that you should know of. The recent bear markets. Did you know that there have been a total of 33 bear markets in the approximately 122 years that have passed since the beginning of the 20th century? During that period, bear markets happened due to various factors. Nevertheless, the 3 most recent market downturns are the ones that investors today are most familiar with. One occurred from 2000 to 2002. This was caused by the rapid expansion of the internet. The fast uptake of the internet, sometimes known as .com disaster, sparked a rush for the so-called online corporations to go public. As money flooded into underfunded businesses in an effort to profit from the next best thing, the value of many undeserving companies rose. As valuations soared, many investors cashed out, leaving the rest of the market holding the bag. The Nasdaq dropped by 75% because of the outflow from online stocks. The next bear market came in 2008 to 2009. This is following a trend of subprime mortgage lending and subsequent conversion of the debts into investable securities. The ensuing financial crisis caused many homeowners to lose their homes to foreclosure and slow down economic activity around the world. When all was said and done, the S&P 500 had plunged by up to 50% from its previous high. Then in 2020, it was caused by the pandemic. The world economy collapsed as soon as the COVID-19 was formally deemed an emergency. The stock market fell at its fastest rate ever because of the downturn in international markets. Even though no bear market is ever the same, they may typically be divided into 4 phases. Phases of a bear market. The first phase is characterized by high pricing and high investor sentiment. Investors start withdrawing their money from the markets and reap profits as this phase ends. In the second phase, stock prices begin to fall significantly, trading activity and corporate profits decline, and previously positive economic indicators fall below average. As sentiment starts to drop, some investors begin to panic. This is referred to as capitulation. In the third phase, speculators begin to enter the market, which raises some prices and trading volume. In the fourth and final phase, stock values continue to fall slowly. Bear markets begin to give way to bull markets when investors become attracted again to low pricing and positive news. So, what is the bright side of a bear market? In a downturn, how do you invest? How to invest during a bear market. Being aware of the difference between bull and bear markets is the first investment trick in a bearish slump. If for nothing else, you can have one without the other. Bull markets are almost always the immediate outcome of bear markets, and bear markets are almost usually the direct result of bull markets. The first strategy to invest during these times is diversifying without disengaging. Growth equities suffer worse during bear markets than value ones do. By happy accident, lower risk stocks have reduced long-term returns comparable to riskier ones despite the decreased risk. Even if it is long overdue and takes place in the middle of a bear market, some diversification into value stocks for portfolios heavily weighted towards speculative stocks can pay dividends not only just literally but figuratively for a significant amount of time after the bear market has ended. Cash has a role in a well-diversified portfolio, even if it doesn't produce much income. It provides a reserve of buying power that may be quickly marshaled to take advantage of possibilities presented by the downturn market. However, if you invest a sizable amount of your retirement fund in cash during a down market, you'll have the difficult problem of deciding whether to redeploy it, when to do so, and where to do so, or risk lower long-term returns. Market timing is tricky, and attempting it is likely to leave you poorer. Participants in the Fidelity 401k plan who reduced their equity allocation to zero between October 2008 and March 2009 and subsequently reinvested in stocks after the downturn gained 25% through June 2011 versus 50% for those who left the allocation alone. Many participants in retirement plans were left behind by the S&P 500's 54% rebound between early 2009 and fall 2011. According to one study that focused on workers between the ages 51 and 59, the average account balance climbed by only 7% during the same period, and 45% of the workers saw a decrease in their retirement savings. The second strategy is dollar cost average. In any weak market, timing the bottom will almost never be possible for investors. Nobody can predict exactly when a trend will change, but there are typically indicators that can help us determine when we are coming closer to the bottom. For example, when prices begin to look like bargains, investors may wish to invest little money in high-quality companies even though their market capitalization is decreasing. Purchasing shares of excellent firms when they decline in price, often known as dollar cost averaging, can lower the average cost per share of a portfolio. Dollar cost averaging is a fantastic technique for long-term investments with high conviction since it allows investors to create a strong position at a low cost. The lower price should be considered a steal if the stock is really a fantastic long-term investment. Then comes our third strategy, buying defensive stocks. Investors should try to add defensive stocks when diversifying their holdings during a bear market. It is nearly always viable to create defensive positions in equities that often outperform the market in slower economic periods, depending on what brought about the bear market. For instance, when it is anticipated that the economy will be in a state of weakness, the stock market for the healthcare industry typically performs better than that of other industries. When money is tight, people are least likely to make cuts to their healthcare. Defensive investments can help investors keep their money in their bank, while most other equities are falling, even though growth won't be as explosive. Finally, invest money you won't need for at least 5 years. It is challenging to trade stocks for a profit when there is a lot of volatility in the market, especially during bear markets. Even while some traders excel at constantly buying and selling stocks, the riskier a trade is, the shorter the period a stock is kept. On the other hand, the longer an investor holds a stock, the greater the chance that the stock market's cap will increase over time. Investors should therefore only put money into markets that they will not need for at least 5 years. When investors do this, they reduce the need to take money out of the market when stock prices are falling, which allows the shares a chance to increase in value. As we wrap up, understand that bear markets are not a reason to worry. They are an opportunity to reduce the risk, diversify your portfolio, and earn more returns. So, are you ready to confidently take on the next bear market? How will you apply these strategies to your own investment portfolio? Comment down below. That is all, and remember to hit the like button and subscribe. See you in the next video.